Hello everyone and welcome to this module on share market framework. In this video, I am going to mention a couple of stuff that you need to keep a track of if you are investing in the stock market. First, let's start with the indices. You need to keep a track of Dow Jones, Nasdaq, which are US indices, and the next is the US ADR. ADR stands for American Depository Receipts. Suppose let's take an example. Infosys is listed in BSE or NSE as INFI. The same stock will be listed in US as INFI ADR. There are other ADRs also, such as SBI ADR, HDFC ADR. Basically, it gives an idea how the stock is performing the night before. Suppose a stock is gonna fall on Tuesday. Monday night, you will have an approximate idea how much the stock can fall. The next is SGX Nifty or SGX Future. This gives us an idea that whether gap up will happen or gap down will happen when the markets are going to open at 9:15. Then other Indian indices which you can keep a track of: Sensex, top 30 companies in India, Nifty 50, Nifty Bank, Nifty IT. There can be other Nifty also like Nifty Pharma, Nifty Automobile. You can keep a track of that. So around afternoon, the European markets will open like approximately 1:30 p.m. So suppose a stock is going like this from 9 o'clock to 12 o'clock, and suppose suddenly at 12:30 it makes a run. Probable reason might be because the European markets opened and there is a positive global market opening close. So this might be the reason. And similarly, the market can fall also after 12. The other thing which you need to make a note of is top gainers and losers in the market. Two things: overall in the market and in Nifty 50. The other thing is FII and DI data, investment data. Foreign institutional investors and domestic institutional investors usually buy in very large quantities. The sentiments in the market depends, like suppose FIIs bought more than DIIs or FIIs sold more than DIIs. This indicates positive or negative trend in the market. DIIs are usually Indian mutual fund companies or LIC, very large companies which buy Indian stocks. Then you need to make a note of stocks that are near 52 weeks, 52-week high and 52-week low. The other thing which you need to make a note of is gold or silver rate, Brent crude, and dollar price. Suppose dollar is like 83.16 rupees. Well, I will explain why you need to make a note of all this in the next slide. You need to keep a track of stock specific news. Suppose you are investing in SBI Bank, you need to keep a track of SBI related news. Suppose if any person X, say XYZ, has taken a huge amount of loan and has not paid back, and suppose SBI gets to know and there will be a news, so the next day there is a decent chance that the stock will fall. You need to read a good newspaper such as Business Standard. I'm not promoting Business Standard. You can also read Economic Times and other papers. I'm just saying Business Standard is a very good newspaper. Now I'm going to give a few pointers when you are considering this, and I'll be explaining what I told in the previous slide. You will understand in this slide better. Suppose there is a share buyback. The company announces a share buyback. Depending on the type of buyback, the price of the stock can go up. Suppose a company XYZ is trading around 1500 and it announces share buyback and around 1650. So there's a decent chance that the price of the stock from 15,500 will rise up until 1650 or further. Usually, depending on the type of purchase of the share buyback, this can happen. Gold, very important. Suppose the gold price increases, jewelry companies, what do you think will happen? The jewelry companies will be making a loss. If the gold price increases, jewelry companies will make a loss. And conversely, gold finance companies like Muthoot will be making a profit. I'm just giving an example here. And crude oil. Crude oil, what do you think will happen if the price of the crude oil increases? Well, crude oil is used in chemicals, paints. So if the crude oil price increases, these industries will make a loss. Dollar. This is why you need to keep a track of dollar. Price of the dollar increases, then Indian companies trading with foreign currencies will make a profit. The IT, pharma companies, these companies will make a profit, and metal companies will make a loss. This is just a suggestion, but I don't think you need to take it very seriously. I would suggest you not to invest in large cap mutual funds. Instead, you can buy large cap stocks. Only to say this because you can reap more benefit of if you directly invest in large cap stocks instead of mutual funds. Usually these funds have less returns such as 12 to 15%, like very less than 12 to 15%. Instead, what you can do is accumulate large cap stocks at very good price. Opportunistic buying. These companies must be fundamentally strong. Next, I would suggest you to invest in index funds. If you are bullish about a particular sector, say banking sector, you can invest sectorially. There are Nifty index funds for various sectors like Nifty IT, Nifty Bank, Nifty Pharma, Nifty Auto. You can invest in these sectors. Usually, index funds have a very low margin of they charge you very less, such as 0.1 to 0.2% charge. But other regularly managed funds might go up to like 0.8% also. But this will help you save commission. Suppose you want to take risk, I would suggest you to invest in small cap mutual funds. Avoid penny stocks or small cap stock specifics. Like you can start out by investing small cap mutual fund. If you are a beginner, as you advance, you will get to know that you are at a very okayish level in stock market. Then you can start to invest in small cap stocks directly. I just want to mention about pension and PPF. You can just search Google or YouTube. NPS, National Pension Scheme, and Public Provident Fund. Very good instruments for investing in a long term. Better than nothing. So most of you would have heard about NPS type fund, tier 1 account. There is also a tier 2 account. This charges very low commission such as 0.1% for index funds, I think. And PPF, right now it has around 7.1% interest rate. And I think it has a lock-in period of 15 years. Basically, it is tax free at the time of maturity, and you can claim tax under 80C section. You can get more information in other videos which is already available in YouTube. I just wanted you to know about these possibilities. And this concludes the module.